In this week's update, markets brace for an expected rise in US interest rates, stock markets wilt as talk of trade wars build, Facebook shares suffer as scandal strikes, and the Bank of England meets after a lacklustre update on the nation's finances. The main focus of attention as the week gets underway is the US Federal Reserve, with markets believing that a rise in borrowing costs this week by another quarter point to a range of between 1.5 and 1.75% is a racing certainty. The bigger question is what happens after that. Will the Fed see fit to raise 3 times in 2018 or 4? Recent noises from the Fed suggest that the biggest concern amongst policy setters is that the US economy is running too hot and needs cooling off. Driving the growth spurt is the programme of tax cuts handed to corporations at the end of last year. Undermining that argument somewhat is the fact that inflation remains below target at 1.7%, but new chairman Jay Powell and his colleagues seem to believe that price rises risk taking off from here. The intentions of the Fed and whether it expects to raise rates more quickly should be detectable within the dot plot that charts the expectations of Fed policymakers. Another big clue that the Fed is getting more hawkish would be an increase in the neutral rate. That's the level of interest rates that the Fed believes keeps the economy in equilibrium, neither growing nor shrinking. The neutral rate has fallen over recent years as central bankers lowered their expectations for global growth. Were it to rise, it would suggest that the eventual destination for rates could be higher than currently imagined, dealing a blow to the lower for longer thesis. One final subplot that could be resolved this week is the question of whether Chairman Powell will expand the number of press conferences delivered by the Fed. This matters more than you might think. Press conferences are currently only scheduled to follow half of the Fed meetings that occur each year, and it has become convention for changes in monetary policy to take place only at meetings followed by a press conference, so as to give the chairman an opportunity to explain the move. More press conferences, therefore, will be taken as a sign that Jay Powell wants to hasten rate rises from here. Yields on US Treasury rose ahead of the Fed meeting, with benchmark 10-year government bonds at 2.86% at time of writing. In stock markets, the week started badly with falls across global bourses. The FTSE 100 dipped more than 1% to below 7,100 on Monday, following a trend in place across Europe as the German DAX also fell 1% and the Euro Stoxx 600 index was down 0.7%. Technology stocks were among the biggest losers, with futures markets suggesting the Nasdaq would suffer at the start of the week. Those falls may be even worse thanks to a large share price fall at Facebook. The social network lost almost 7% of its value yesterday, that's Monday, after the news broke that it had granted a controversial online marketing consultancy, Cambridge Analytica, access to the personal profiles of 50 million of its users, including for the purposes of winning the 2016 presidential election for Donald Trump. Other tech stocks fell in sympathy. Google parent Alphabet was down 3%, for example, as markets weighed the likelihood that regulators will now get tough with the all-powerful tech giants. That's not the only source of gloom for equities. There have also been growing expectations that the EU will enact retaliatory trade tariffs in response to moves by the US. Supposed targets include peanut butter, orange juice and bourbon whiskey. Markets are now taking seriously President Trump's threat of applying tariffs of 25% and 10% on steel and aluminium respectively. Those tariffs are due to come into force by the end of March. In the UK, the Bank of England also meets this week. No change in policy is expected. As ever, it will be the hawkishness or otherwise of the language used by Governor Mark Carney that will be scoured for clues to the likely path of UK rates from here. The Governor has already told markets and borrowers to get ready for rate rises, and at least one rise is expected in 2018. A rise can be justified on the grounds that inflation remains above target at 3%. But the bank will be wary of doing anything that harms anemic levels of growth in the UK economy. That weak growth was underlined at the spring statement last week when Chancellor Philip Hammond modestly upgraded growth and deficit forecasts. The improving picture was welcome, but did not reverse the more negative forecasts made as recently as November that suggested the UK will witness sub 2% GDP growth for the full 5-year forecasting period. There was no news in the spring statement on the possible course or cost of Brexit. Our exit from the European Union represents a great variable, of course, in the likely performance of the UK economy in the years ahead, but much of the detail remains unknown. This week at least brought news that the UK and EU have agreed on a transition period to begin on the 29th of March next year. That offers some more time to companies which are under pressure to enact their contingency plans. Elsewhere in markets, oil prices have dipped after rallying at the end of last week. Falls may have been deeper were it not for an escalating war of words between producers Saudi Arabia and Iran. Saudi Crown Prince Mohammed bin Salman has threatened to secure a nuclear arsenal if Iran does the same. The threat that supply could be disrupted put a floor under oil prices, with Brent crude down to $66.11 a barrel and WTI also down 62.17. Gold is currently worth around $1,310 an ounce, and in currencies the pound is worth $1.41 and €1.14. In the corporate calendar, there's results this week from Kingfisher, British American Tobacco, Sky and Next. The high street retailer will be watched for further signs of stress that has been stalking the traditional high street retailers. That's it from me. I hope everyone has a great week.